Hello ladies and gentlemen, and welcome to my screencast in explaining the accounting of receivables. Firstly, a brief description of accounting receivables. Receivables represent a business's claim on an asset of another entity. The most common form of receivable is accounts receivable. An accounts receivable is recorded within the current assets in financial accounting. So let's take a brief look at the recording of accounts receivable. Accounts receivable is recorded at the exact time of sale, despite cash being paid to the owed party yet. In this first example, let's imagine a business sells X amount of its product to a customer on account. This would lead to debiting accounts receivable and crediting sales at X amount of dollars. In this second example, businesses must adjust journal entries upon cash being collected. We eliminate accounts receivable through crediting and debit cash to increase its total. Now let's look at reporting accounts receivable, as it's very crucial financial information for a business. Accounts receivable must be reported to measure any losses of uncollectible finances. Companies do not normally collect all of their receivables, whilst customers don't always pay. Customers may have financial hardships, may be relocating, or may even refuse to pay. Let's take a look at what uncollectible receivables actually are. Uncollectible receivables are the losses from the inability to collect accounts receivable and are recorded as a bad debt expense. Whilst recorded within operating expenses, the two methods of bad debt expense are the direct write-off method and the allowance method. The direct write-off method demonstrates bad debt expense recorded when a company determines that a receivable is uncollectible and removes it from its records. The example journal entry highlights the use of bad debt expense to directly write off uncollectible receivables in a quick and simplistic form. The allowance method utilizes a two-step process in recording uncollectible receivables, one to record the estimate of bad debt, and two to write off the receivables when they become uncollectible. The first part of the example highlights the estimating of bad debt expense in the allowance for doubtful debt account in a normal business sale. Here in the second part of the example, it shows the receivables being written off after they are deemed uncollectible. Estimating the bad debt expense in the allowance method is further completed through the percentage of sales approach or percentage of receivables approach. Now I hope you understand the accounting of receivables a little bit better now. Thank you very much for watching.